Okay, so hello everybody. So it's my great pleasure to welcome you for this session devoted to climate change risk. So my name is Laurent Clerc. I work at the French Central Bank, and I was formerly working at the ACPR, which is the supervisory authority in France, where I led the climate stress test carried out by the institution. And from this perspective, to open this morning, both the keynote and the panel discussion that will follow, let me raise some of the challenges I met as a supervisor with respect to this risk, and hopefully the panelists and the keynote will touch upon these issues. So from my perspective, there are four main challenges. The first is obviously the extent to which climate-related risks are factored in by the financial industry. So with respect to transition risk, I would say that some progresses have been made, thanks in particular to regulation, especially in Europe. But there are still a couple of issues with respect to transition risk. One is one difficulty to identify greenwashing, especially from a supervisory perspective, and to design the best supervisory tool. Let me just give you an example. If you think in terms of financing, would you encourage banks to provide financing to the green sector or to the brown sector? So obviously you would encourage the banks to provide it to the brown sector just to make sure that the transition will be made. But obviously, if the firms do not adapt, then you keep on going financing emitting firms. So that's one of the challenges. And another one which is currently underestimated is liability risk. So it's not factored in by financial institutions. And it has played the other way around. Initially, we were expecting liability risk to be faced by institutions because they would not engage into transition. But it turns out that due to local American authorities, when they used that threat, and it led to the collapse of most of the global alliances that were designed precisely to cope with transition risk. So the main issue for the financial industry, and that would be part of the issues raised by Monica and by the panel, is related to the extent to which it is able to take into account physical risk. So here the second challenge, especially for banks, is the difficulty to link physical risk to default risk. So especially in France, so it will depend obviously upon the institutional and regulatory design. But in France, if you think about it, for housing loans, for instance, they are not based on the value of the house or the collateral, but on the revenues of the borrower. So as long as the revenues are not hit by climate change risk, there will be no default risk. So even if your house is flooded every year and it's worth zero, the household will continue to pay its debt and there will be no default observed by the banks. One aspect in France is that we have also a good insurance coverage that will also limit the risk, and also an efficient national catastrophe regime. When we designed the first stress test at the ACPR, we ran some case studies based on extreme events, and the outcome was the opposite of what we thought. Not only we did not observe default for firms that were exposed directly to the risk, but instead we observed an increase in their productivity because they were able, thanks to insurance coverage, to rebuild their capacity and therefore adopt new capacities, more performant. So it was a kind of destructive creation in a way. The first challenge is the horizon. So I'm referring obviously to this tragedy of the horizon, but one is especially when you design a stress test. When you look at the worst scenario and the best scenario at the horizon of 2050, the difference between those two scenarios are very little. So when you try to transform the two scenarios into risk, the difference is not very clear. So you need to take into account longer horizon, which is usually out of the capacity of the financial industry and not properly accounted for by the model. And the last challenge is the extent to which climate risk represents a systemic risk for the institutions. So it is a systemic risk to the extent that once there are climate events, they will touch or affect all the industries or all the firms. So in a way, it's not necessarily well diversifiable. But when you look at the outcome of most regulatory stress tests, it turns out that despite the fact that they are significant, those risks appear to be manageable by the industry. So obviously there are caveats, and these are some of the issues to be accounted for, perhaps by the researchers and the panelists. The first is obviously the design of scenarios. So one can consider that so far the scenarios are not sufficiently affecting the industry, so that's why their result is difficult. Another issue is, and perhaps this is a part of a hidden risk, I don't know, or related to aggregation effect. So if you look at the outcome of those scenarios or the impact of climate change, usually the analysis is carried out at the local level or at the firm level, so you miss aggregation effects. So there is an interesting outcome in the literature, which is the work carried out by Bilal and Kansik, who look at macroeconomic perspectives and find much impacting effects of climate change risk. Another difficulty is to take into account cascading or compounding effects and tipping points. So typically they are not necessarily well accounted for in the design of scenarios. And the last one, which is an issue that is also affecting in a way some of the result by Monica, is the extent to which you are able to take into account indirect exposures. So usually the measures we have are mostly based on direct exposures, but there are many indirect links. And that's why, in particular, when you try to measure your exposure to systemic risk, and climate risk, what we call scope 3 measures are the best to the extent possible. So with that further consideration, let me introduce Monica. So Monica Billio is a full professor of econometrics at Foscari University in Venice. So she should have been here today, but unfortunately she faced some difficulties to travel, so that's part of the hidden risk also for the organizers. She has authored numerous publications in leading international journals in econometrics and finance. It turns out that she visited the Banque de France a few years ago, so she was working on financial econometrics. And then she came back, she was working on systemic risk, and now she's working mostly on sustainable finance and ESG risk. But as you will see, all those risks are connected in a way. She was also director of the Treviso campus and the Department of Economics at Foscari University. And she coordinates also numerous research projects funded by the European Commission, the European Investment Bank, the World Bank, Eurostat, and the Italian Ministry of Universities and Research. So the paper she will present is entitled "How Climate Risk Shapes US Systemic Stability through syndicated lendings. So without further ado, Monica, I give you the floor. Thank you very much.
Thank you, Laurent, and I'm really sorry for not being able to be there. It was really my pleasure, and but I mean, it happens. As you said, it is part of the hidden or risk, let me say, that that can happen. Then let me thank you for the introduction. Thank you also for the overall introduction that partially allow me also to introduce the paper. Then here we are with the, as you said, what I'm presenting is this paper, How Climate Risk Shapes US Systemic Stability Through Syndicated Lending. This is a joint paper with Alfonso Dufour and Anna Sina, both from, also Alfonso is a colleague that he was in Foscari and now at LA Business School reading, and Anna is a joint PhD of us. Then what we try to understand is how do climate related shocks affect not just the individual banks, as you said, but the stability of the banking system as a whole. Then this is a way in which we can understand if the climate-related shock can be drivers for systemic risk. We are concentrated on US syndicated loan market. This is quite an important market for corporate financing, but it is also a market where we can understand how the risk spread across in institutions. Then let's start from the big picture. The basic idea is that the risk does not affect banks through only one channel, but it works through a number of transmission mechanisms. Those mechanisms eventually show up as a financial risk, and then, as we say, they become material. Then, following the BIS framework, we can distinguish between physical risk and transition risk. Physical risk can be, includes both acute events like wildfire, heat waves, floods, and storms, but also the chronic parts. Then this means rising temperature troughs and long-term, let me say, changes in rainfall patterns. What about the transition risk? The transition risk comes from the adjustment of to a low carbon economy, and that can be reflected in the changing climate policy, technological change, and the changes in investment and consumer preferences. So why these matter for banks? All these climate drivers can clearly translate in the classical dimension of financial risk. Then credit risk, this is something that Laurent shortly reported before. Market risk, liquidity risk, and operational risk, certainly. Those, what we say, they are material. In this paper, we focus on systemic risk as a way to look at all these questions together, then in understanding how they can impact on the banking system, and then how they can increase the fragility of the banking system overall. In some way also, and then I take a word that Laurent introduced before, compounding through the system, since here what we look is the system all together. This last year, there is clearly a large and growing literature showing that climate change matters for finance. A lot of this work looks at one channel at a time, and some papers focus on loan pricing, others look at physical risk, extreme weather events, for example. Others focus on transition risk using emission, decarbonization indicators, or green versus brown measures. There is an important strand of literature, and starting from the seminal paper by Engler and co-authors, uses text-based indicators to capture climate attention, concern, and or policy discussion and other dimension of the transition risk. Banks are exposed to all of these driver of risk, and not just one climate risk, climate signal, let me say, at time. Then what we try to do in this paper is to take a broader approach and then combine these several climate channels in one empirical framework. Then, looking at our contribution, first, what we do is to work and then to construct a climate-adjusted bank-level syndicated loan portfolio. And the idea is that to not stop at loan origination, but following Blick and co-authors, we also take into account that these loans clearly are traded in the secondary market. Then what we try to capture is the actual exposure after origination and not just their initial allocation. We are thus considering the portfolio that banks have decided to hold, and then looking at this aspect as an important point. The second contribution is that we combine three broad dimensional climate risk. Then the bank's environmental lending orientation, then looking using this climate just bank level syndicated loan portfolio that we consider, looking if the portfolio are more toward environmental stronger firms or not. In practice, as I said, according to the portfolio that are held by banks, we consider at the regional level physical climate measures, then looking and reflecting banks' geographical lending. And third, we consider several text-based proxies of climate sentiment and policy attention, in this case, looking for the transition risk. Then we worked with quite an important range of climate risk measure. At the end, what we see are 4 drive cross-sectional climate indicators that really are relevant, and they are, and here you also recognize according to the color what they are meaning. Then the bank's environmental orientation, as I said and introduced shortly before, which appear to mitigate risk, while extreme weather events, in particular in the south, temperature anomaly in the east, here referring to the US region, and climate policy shock appear to tend to temporarily amplify systemic risk, then creating uncertainty and really heading to the need to look at the systemic risk for the impact for the systemic risk for the banking sector. Now, regarding the data that we consider, we worked with Thomson Reuters Dale Scan for US syndicated loans, and then we consider several sources at the loan firm, climate and bank levels. Here you have. For the ESG characteristics, we use Refinitiv, Refinitiv. For the physical climate risk, we consider data from the National Centers for Environmental Information, and we look at several of the indicators that are available. And as I said, we also include a broad set of text-based climate indicators according to several papers in the literature. And as a systemic risk measure, we consider the measure produced by the VLab, then the market-based measure as risk. And it is defined for each lender I amongst T, and the different pieces inside are then averaged also in this indicator. Clearly, we have also some macroeconomic controls, and we also control for other, more general variable relevant for systemic risk that we also considered in some previous paper. Just to have a look on what we are considering, here what we have is the US syndicated loan markets that appear large, as I already said, and cyclical. You see this strong growth before the financial crisis in 2008, then an important drop, and a steady recovery, and if it is not yet to the value obtained in 2007. What is relevant is it continues to be a major source of financing for large firms. On the right, you have the geographic concentration of the loan issuance. Lending is not evenly spread evenly across the country. There are some major economic states. There are Texas, California, and New York, and this is in line also with the economic relevance of these states. Then what I can say is that the geography, and then this is also the reason for which we work at looking at the geography, it is a link between climate condition and financial risk. Here I know that it's quite difficult to read this table, but here what you have is the regional climate patterns. Then here they are the climate risk variable, looking at them as a measure for the chronic physical risk. Here you have what you see is I hope what I can say you is that there is a broad pattern of persistent warming across the country, and you see with these positive temperature anomalies, and this is for all major regions. In the south, the south is structurally hotter, we know, but Texas stands out in particular for both high average temperature and more intense heat condition. The east, for the east, we have the highest precipitation level. levels, and then we see positive precipitation anomalies, and this is the case of New York. For the West, especially California, it's not exactly the same country that the same region, state that we cited before. There is a combination of higher temperature anomalies with negative precipitation anomalies. Then also thinking to the how the physical climate risk impact, it is clear that it is not uniform across the US states. And here you can also see in terms of the cost incidence of extreme events. Here you more or less you see affected the same state. This is on one side given by the fact that we said that these states have higher chronic level of risk, but it's also the states that has the more economic importance, the highest economic importance for US. Here you have the biggest impacts for the total cost. Then two example, the tropical cyclones here are more on the east, and the wildfire. The wildfire, if you look at the level of the impact in terms of cost, this is not so high as the previous one, the tropical cyclones, but it has become really relevant in the last years, since the spike in costs, especially in California. I think that you clearly remember it is 10 times what it was in the average in the previous year. Then let's go for the type of variable and indicator that we introduce. As I said, this is our in some way main contribution also to understand in which way we can represent also the choices by the bank at single level, but after overall as banking system. This is the Lender Environmental Friendly Index, and what we measure is how environmentally oriented is banks lending. As I said, this is obtained using the Blinkel and co-authors methodology, and then if we look at the result, the higher values means strong environmental commitment of the lender, and overall this means a choice by the bank, the single bank, and then the overall system through this type of lending and then investment. Here it is lender chronic or physical risk exposure. It is weighted at the regional level. Here, what he tried to represent is the lender's exposure to chronic climate-related fiscal risk. And here, the way in which it can be read is that higher values means greater exposure of the lender to chronic climate-related physical risk. Then in some way, we are trying to put together the consideration that we made before. Here, the empirical specification. As I said from the beginning, what we try to explain is the delta in the systemic risk, and we put together all the different channels. Then the empirical specification, what you see is the three main indicators, then the environmentally friendly index, the temperature anomaly regional weighted index, the precipitation anomaly regionally weighted index, and the extreme event weighted impact. These are the three indicators overall that represent the physical risk. And then we have the climate media tension. In this case, it's more for transition risk. And then we see different type of variable. And then, as I said, there are controls that take into account, several variables, then both in terms of lender network centrality and more macroeconomic also variables. Here we also consider the result of our previous work on, then we worked with we also introduced the syndication risk from leverage and covenant light loans. And as I said shortly before, the physical risk indicators are at regional level. Then we distinguish between Western, Eastern, Central, and Southern. Here, the result, again, I know that it can be difficult to read. It is always difficult to find the proper way to represent this type of result. Anyhow, you slightly see this light color trying to introduce also the result. What we find is that the environmental lending orientation is significant, and it is through all the region. You see West, the first column West, the second column South, then East, Central, and all regions all together. It remain stable. Then looking at the indicator for physical risk, in this case, they appear at the regional level, as I was said, the temperature more for the south and east, and these are remain for the, also when you look at the all regions together, and the same for the extreme impact cost, but that is impacting more for the south, and this remain also when you look at the all region together. For the other variables, they remain consistent, let me say, according to also the result of previous work. When we move to the understanding the relationship between systemic risk and the news-based climate variables, here what we present is the Facchini and co-authors variable, again based on news, and here we worked also on the relevant lag to appreciate also the impact. At the end, here what is presented in the 4th month lag, it has been selected also using some statistical indicators, and what you see is that what is really relevant is the U.S. climate policy. Then also the international sums that appear relevant, but the two variables are quite similar. And then really the impact is from the climate policy. What you can also see in the second part of the table is that the other variable, looking at the last column, you see remain relevant in the same way that it was in the previous table. Clearly, we also worked with some robustness checks, checking for alternative physical risk measure, and the result remain consistent. We also look at alternative news-based indicators, as I said from the beginning, but the main findings again remain robust, and what is the relevant part is the variable that represent the policy choices. And we also worked considering alternative environmental proxies. In particular, here we have worked using essentially the E part than the E pillar, but the result remained the same if you look at the ESG score. Here, to tell the truth, it is also, in other work, we also look at more in detail on the way in which the ESG score are also defined. And it is true that the pillar E is the pillar that it is the main driver usually for this type of score. Then there is no surprise on this. Now, policy implication, and this means also our result. It is, the climate risk is material. Then this is one of the points also that Laurent introduced at the beginning. Now, here it is material not only for the single bank, but for the system. Then it is important to strengthen resilience to extreme event, and to take into account also this chronic risk measure than the temperature anomalies into the credit risk assessment. This is again a need to work more on the way in which it is possible to introduce this type of consideration in risk management, then in particular in credit risk assessment. And then this is really I think one of the main points, in particular in US, but overall, let me say, also in Europe, in this last period, then it would be important to reduce the policy-related uncertainty. Here, the clarity, both in terms of action, the horizon of the implementation, the climate policy, clearly can impact and can reduce the adverse effects of, on expectation, investment, and overall on financial stability. And here, then, thank you for your attention, and happy to follow the remaining part.
So thank you, Monica. So let me check whether there is a couple of questions. Is there any question? No? So in that case, I invite Peter Tankov and his panelists to join the stage.
Thank you.
Right. Good morning, everyone. We will now proceed with the panel on climate-related financial risks, the hidden pitfalls, with a focus on physical climate-related transition risks. And the hidden pitfalls that we identified are first, the fact that these climate-related transition risks, although climate-related physical risks, although their importance is recognized, and the importance for financial stability in particular, they are not always clearly visible in the balance sheet of banks and insurance companies, especially when they're due to indirect exposures or to supply chain related exposures. So this is the first pitfall. And the second one is related to the models themselves that are being used to evaluate these physical climate risks. Because the models are often opaque, and sometimes they are based on data that maybe is not so reliable. So this second pitfall is related to the model risk associated to models used for climate-related physical risks and the lack of transparency of these models. Today, this morning, we have a very distinguished lineup of speakers, starting from Jean Boissineau, who is director at the Secretariat of ACPR, the French regulator of insurance and banking sector. Then we have Priscille Béguin, the CEO of Climera. Then next, Pierre Weiss, the Chief Financial Officer of Allianz France. And finally, Elena Maximovic, who is the CEO of Weather Trade. Yes. Thank you. And myself, I am Peter Tankov. I am professor of finance, quantitative finance in particular at NSIE, and scientific director of Park Foundation at the Louis Bachelier Institute. And at Park Foundation, the physical risks and the climate risks in general are a very important topic. We both develop indicators of climate risk, and in particular physical climate risk, in the context of our database project, the PLADFS project. And also this year we have started, last year, we have started the project of Climate Physical Risk Cookbook, a detailed review of academic literature and practitioner methodologies for evaluating physical risk, with the objective of putting some order into these methodologies for the attention of financial and insurance sector. And without further ado, I will proceed with the questions to our distinguished speakers. And in the interest of time, we will skip the round of presentations, and I will ask every one of you to start with a quick presentation of yourself and how your work is related to climate risks before you answer my questions. So I suggest to start with Pierre, who is the representative of the industry. Then we will proceed with data providers, and finally Jean will have the last word. So Pierre, from an insurer's perspective, how do you deal with climate risks that are material but only imperfectly visible in the firm's balance sheets, because in particular they may be related to supply chain exposures?
Thank you, and very happy to be here. So I'm the Chief Financial Officer of Allianz France. It's a major international insurer which is well exposed in France. And I deal so with climate risk on a daily basis in my P&L and in my balance sheets. And it's always a pleasure to speak about hidden risk in front of the regulator as a CFO. Easy one. So I would agree that on the direct risk, on the physical risk, I think right now our exposure is well modeled and well seen, and it's not so much hidden. And the good thing also with, and that's also linking to the stress test that were mentioned earlier, the good thing is that our exposure is only a one-year exposure, the insurer exposure, so we can adapt quite quickly the exposure to the direct physical risk, and this is one of the resilience parameters that we have. Now, if we turn to indirect risk, which is indeed, from my perspective, the most important one, because it can lead to very high exposure for us that we don't see directly in our scenarios. This indirect exposure is coming, like in cyber, it's coming from the supply chain in two ways. One way is that basically we guarantee some contingent business interruption. So basically we guarantee for some companies the fact that they will be able to continue their activity even if their suppliers are defaulting on the spare parts or the parts that they were supposed to give them, to provide them. And here, of course, you can be exposed all over the world because you insure someone in France, but the providers are everywhere. And if a climate event happens to the supplier, you have to pay some contingent business interruption to your policyholder. The other way where it's also spreading is through trade credit insurance. And so this is the other way around. Basically, you're guaranteeing the fact that you'll be paid by your clients, but that the company will be paid by its clients. And of course, if the physical event is affecting the clients of the companies and the company defaults, then of course you don't get paid, and we have to come to pay on the trade credit. So through these two effects, you have basically a whole chain of exposure that is exposing you not only to the physical risk of your clients, but all their value chain. And here it's quite complex to model because by definition in France, most of the policyholders are well covered. Most of the companies are well covered thanks to the CatNat regime. But all over the world, this is not the case. And often you have insurance gaps, and you need to know how your clients and/or your suppliers are insured. So you need a two-level model. So you need a correct model on the climate risk, and we'll come back to that, and the exposure of the physical assets. But you need also to map all the physical risk of your clients and of your suppliers to be able to do that. So we try to do that. I'm not going to say we are very good because it also implies several parts even within Allianz, several parts of the company, because trade credit is done by one part, CBI is done by another part. Sometimes we insure also the local companies through our subsidiaries there. So we try to map the links between the companies on both sides, clients and supplier, try to have a rough view of their physical exposure and try to model the impact on top of that of the climate risk on this whole chain. But you see, we have really double, let's say, error adding. We have the error on the initial model of the climate risk, and all the errors you have, all the limitations you have on the modeling of the dependencies between the companies. So it's really a really work in progress, and I think it will take ages before it really materialize into a specific adaptation. One other way we deal with this risk is by limiting our exposure. This is the usual answer of an insurer. Okay, if you don't understand fully what's happening, you try to limit the exposure, and everybody needs to have in mind that the CBI, so the contingent business interruption policies, have very low guarantees, which is increasing the risk, and because it means the risk will spread more through the whole system. But at the same time, it's also a way for us to get protected before we get to a final model. And then the last point is that we are not only insuring liabilities on our liability side, but we are also asset owners. And of course, on the asset, we have some equity, we own some stocks, we lend some money to companies, which can be the same as the one where we provide coverage through the liabilities. And here also, we try, it's not far from perfect, we try to map the exposure of our assets with the exposure of our liabilities through the direct liability exposure, but also through the indirect liability exposure. But you see that the amount of data that you need to cover and the amount of models that you need to put in place to have a correct representation of your risk is really massive. So that's where I could say it's definitely a hidden risk.
Do you see a space for stronger coordination between banking sector and insurance sector to avoid the type of spillovers that you mentioned?
Yeah, I think this is where we still lack a lot of cooperation, and honestly, already within a group, you're still missing a bit of collaboration because you don't look at the data the same way. But it would be good to have a discussion, at least on the asset owner side, so with asset manager and banks, to have a discussion and for them to know, so they could use our model to know where the policyholders are exposed, and on the other side, we could use the data from the banks if they tell us, okay, where the money that they lend, where the stocks that they own, especially for the asset manager, are exposed. And I think we should, again, it will take a lot of time, but you should arrive to a point where we know if we buy a stock or if we lend money to a company, to which zones in the world and to which type of physical risks this company is exposed, and how this risk will affect their production and their result. And this will, again, take a lot of time, but I think we have the data. It's just a question of having a common model of data sharing and the willingness also to share the data. And I think here the banks also need to go forward, because as I said at the beginning, we have only a 1-year exposure in insurance contracts. So we can stop our exposure quite quickly. Of course, this will have impact for our clients, so we don't want to do it. But if really we face a major shock, we can always adapt our exposure. The banks, by definition, have loans that are much longer, and the ability to cut the exposure is, let's say, less efficient, and especially on household. So here, I would definitely see more cooperation between banks, asset manager, and insurance companies as helpful to better understand, for each of these three actors, to better understand the exposure that they have.
Thank you, Pierre. Now, Elena, what do you see as the main bottlenecks for the integration of physical climate-related financial risks into decision makings at the banks and the insurance companies, and what are the metrics and data sets that are readily usable for such integration?
Thank you, Peter. And I think you saw how many notes I take, so you decided to ask me a question right away. Otherwise, there will be 3 pages of notes. Yes, I have many small comments to add, if you don't mind. So just a quick introduction myself. So I'm originally a climate scientist with more than 10 years of experience in the insurance space. I was working with the Meteo Protect and the DQ Tucker, and Mini Swiss Re. Creating insurance during several years, mostly parametric, but catastrophic as well. And since 2016, so I created my own company, a startup, Deep Tech. It's more deep tech than climate tech. And we use, so it's not just climate data, we use the concept of insurable, uninsurable, because the moment you say something is at risk, when you say something has high risk of flooding, nobody ever understands. It's just completely, I'm speaking with the wall, right? So if I say insurable, uninsurable, it's very understandable metric because, again, no risk means, okay, I don't need to handle. I can invest without any problem. If it is insurable, it means that partial hedging is possible for that location. So it is post-hazard hedging. It's not protection. So we should not confuse it, right? So we're speaking about natural catastrophes. We're speaking about non-life insurance. It's a post-hazard protection. So something happens, and only after we can expect 10, 30% refund, maybe 40%. Not 100%, and only physical damage, not business interruptions. So, yes, the moment when somebody knows that their facility is uninsurable, it means that whatever they pay, it is impossible to have a financial hedging because the risk is too high. The risk is imminent, or the risk is too frequent, or the anomaly is too high. And so the moment when we use climate data, but we translate it with insurance brain, with their logic, how they calculate risk, it makes sense for risk managers. Because the moment we use just the term risk, just a small joke, but it's not that funny actually, but it could be funny at some moment. That half of the conversations I had during these years was, Elena, how do you calculate the risk? And then the person itself, he's asking, are you calculating the average? And I was like, okay. Where do we start? So on one side, we're speaking about risks, and we're using this term, but on the other side, very few people understand. So what is the risk? Okay, so when insurers, they are speaking about the risk, when it is classic insurance, it's natural catastrophe type of insurance, right? So we're speaking about return periods and the frequencies, very low frequencies. It's once in 200 years, once in 500 years events. For banks, asset managers, pension funds, supply chains, these are not the frequencies that they are interested in. And this is exactly what Pierre was saying, that they are interested in frequencies which are once in 5, 10 years. Okay, something that happens every day, it's not the risk, right? So definitely. But there is a mismatch in frequencies and time. So just a quick, France is quite a unique country from this point of view because, for example, in France, natural catastrophes includes drought. Neither other country has this small feature. And in France, there is mutualization. Okay, what means mutualization? It means that in France, every household, they have insurance. In the United States, 20 states out of 50, they have 1% of households with flood insurance. 1%, not everyone. So just how exceptionally France is. But this is the hidden risk. So mutualization, okay, mutualization creates this, supports financial system, right? But mutualization creates the hidden risk. And this is what Laurent was saying in the introduction, that at the end, there is no asset specific risk priced the moment we apply mutualization. So for the banks, on one side, there is an advantage that they can borrow money for any project, any household. But the problem is that the price of insurance doesn't reflect the actual risk for that asset, and at the end, the asset is overvalued, right? So this is one of the hidden risks. Yes, so one of the hidden risks. So just to repeat, so Pierre was saying that time horizons are not aligned between banks and insurance. That insurance, they have a 1 year time horizon. For banks, it's 5, 6 years, 20 years. Yes, and so mutualization is another. So yeah, I can continue further, but I will pass the word further because I'm not alone, I guess, today speaking. Thank you.
Okay, thank you. So, Priscille, a question for you. How can we make models more transparent and comparable without undermining the intellectual property of data providers?
Thank you for your question. So I'm Priscille Béguin. I'm the CEO of Climera. At Climera, we model climate risks with physical model. We try to understand how it will impact economically the clients we work for, and we find solutions that we can deploy to create resilience into portfolio. So we work on three things: physical exposure, economical exposure, and prevention strategies. And when we address the problem of clients, when we address people such as Allianz, they always ask how the model works, where it comes from, where the data come from. And it's always very difficult to be completely transparent and just open the hood and say, ta-da, that's where we're done. Because we have a vulnerability there. If the model is copied, we have nothing left. But our work comes from science. We worked 10 years in R&D before opening Climera. And one of the things we do at Climera is work on two things to create the most transparency possible. First thing is verifying the capacity of a model to recreate historical events. And we propose pilots to our clients to compare their sinistrality data to our model to verify the capacity of recreating their reality through our data. That's the first thing that could really create trust and transparency. It needs to be transparent in both ways. We need to propose our data for their events, and they need to propose their sinistrality data, which every insurance company hates to do. But if we are both on the table with our data, we can really have a conversation around are the two types of data comparable? Are they agreeing to each other? Because there will be some sort of error from both sides. So we need to be able to analyze both of the sides to be able to see if we agree on things, on the reality of the climate risks and how it will deploy on site. And the second thing we want to do is to be able to provide uncertainty calculation on our model. We provide uncertainty with our model. We are able to say, we're sure about their data with more or less error on each of them. It's very hard to do. It's a whole science. It's a lot of energy to be able to propose that kind of indicators, but models without institutes are useless in our mind. We think it's just a bunch of data with no proper anchorage into reality. And once you are able to say, okay, I'm sure at 99%, 95%, 86, 44% of that data, of that reality, of what I'm putting on the table, we know for sure what kind of decision making we will be able to make based on that data and its precision. Because at the end of the day, we are working on questions that will have real impact on people. And the people that will have to make the hardest decision, will I ensure or not, will I follow through or not, will impact economical reality harshly. So we can't base those decisions on blindness. We really need to be able to focus on having the quality of data we know, just not just good data, but data that we know are good and how much they are good.
How do you make sure that these uncertainty estimates are actually used for decision making by your clients? Because just as an anecdote, I was discussing with Jean-Charles Urcade a few years ago, and he told me that you should always provide an even number of scenarios, because if you provide an odd number, they just take the middle one.
That's true. We have three. Yeah, we tend to have a lot of biases as a human being. Most of the time, what we work with our clients to find the right kind of indicators, the right kind of KPIs that they could understand, they can base their answer to the market on. Most of the time, it's really money indicators. So it's basically financial exposure and the incertitude on that financial exposure. It's the easiest way to translate an error rate on a model, on a physical model, to an indicator that is comprehensible by everyone and translatable in every language. So most of the time we talk about error risks and error rate on the physical, on the financial risks. It's the easiest part, but we can manage other type of indicators if some of our clients need more refined or more specific KPIs.
Yeah, do you want to comment?
Yes, Priscilla, if I may add the right, thanks. So I would suggest not starting from any scenario analysis, but starting from historical data. Your clients or your partners, they are not stupid. They know that these facilities, Renault, Peugeot, Michelin, they know which facility was flooded or which facility had drought last year, this year, the year before. SNCF, they know well. So before you even start doing any forward-looking scenario analysis, just provide to any data vendor, provide 3, 10, 20 data points and ask them, so this is how insurance company would do. They say, Elena, for these 3 locations, what do you think about them? And they know that this location was flooded 3 years ago and another was flooded 20 years ago. And this is how they validate. So first of all, you validate any data just looking at the historical. They know what happened. If they had these factors, they operate these factors. They feel it with the skin. They know what it means. So financial, and this is the baseline for insurance as well. When you cross financial loss data in the past, last year, the year before, with the climate anomalies, and you say, and you build your financial model based on historical data, first of all, right? And then you make some assumptions about trends in the future, but the baseline, the baseline that we all use is always the historical data. So, yeah.
Thank you. Jean, what is, in your view, the main regulatory blind spot? Is it insufficient disclosure of physical climate risk, or are these methodological gaps in the models used to assess it? And how should regulation evolve going forward to limit these mispricings?
Wow. Yes. And it's only me speaking, not the regulator. No, many thanks, Peter. Maybe just before I jump to sharing views on this important question, a good reminder, I mean, and piggybacking on what Priscilla just said, a good reminder of why this matters. It matters because this is affecting the real life of real people in the end. And it matters also because the quality of the capital allocation that comes out of this process, be it in insurance companies or be it in banks, somehow shape the future. So the better we make good decisions on that, the better we will be prepared as a society, as an economy, as a country, to face what comes next. I mean, just to stress that it's not just a technical question. It goes way beyond than that. Now, where are the biggest blind spots? I think there is something I didn't hear in the panel and in recent conversation. No one said that we don't have enough data. We have all the data we need, at least for the physical risk, be it in the past or in the future. What we don't necessarily have is data that people really understand and know how to work with, first. And second, it's also all the kind of contextual data that you would need, because once you have the climate hazards, you don't know about the insurance coverage, you don't know about the supply chain, you don't know about a number of things that will really shape the outcome of your assessment. So clearly not the climate data, but some of the data that comes all along. And which brings me to, I think, what is the real blind spot is somehow the good modeling that you should do to make sure that you combine this data with the data that you have internally. I mean, if you have a bank, data on companies' balance sheets, past performance, and so on and so forth, so that basically you can feed your climate data into actual credit risk assessment process, into that kind of asset pricing questions that you are asking yourself if you're an investor, and so on and so forth. So it's more the convergence, first the modeling of the impact, and then the convergence of this modeling with your own financial models.
And I think that was about it. So really focus on making sure that you have the right models and you know how to plug your models in the right ways, because the outcome can be very, very sensitive to hypotheses or shortcuts that you take for that, and a bad outcome will translate into a bad capital allocation and eventually into capital destruction.
Just to complement your idea, Jean, regarding the data and the risk definitions, knowing that at the end it's always the insurer takes the decision whether they back or not the project, whether it makes sense to apply right away from the beginning, the moment we start calculating the risk, evaluating risk, applying the methodology for risk assessment, maybe it makes sense from the beginning to adopt insurance brain, insurance logic for calculating this comprehensible risk data, so that the moment we are speaking about the risk, it's not the far west that, oh, I calculate the average, I take the standard deviation. No, we use insurance brain, insurance standards, insurance thresholds. So if for short time horizons we use a parametric insurance logic with the 26% ratios, with the ratios between pricing and between premium and the maximum payoff. So we use standard coefficients. We integrate climate data with standard coefficients as if we were pricing the insurance to define whether there is a risk or not. Because if at the end, in any case, the insurer who takes the decision whether or not there is the risk. So why using another methodology for qualifying this asset is at risk, this asset is not? If at the end, who cares what you calculated with your methodology if it's only the insurer who has the right of vote?
Yeah. I mean, just trying to reframe, it's really not about saying this asset is exposed to a risk. It's about being able to say, this asset is exposed to a risk, and the impact of the risk will be that. And the risk is not just an average risk; is really indeed a part of the tail of the distribution of the risk. Which brings me actually to something that I see as more challenging. Typically, is that we don't necessarily have collectively. I say we as a sector, system, whatever. We don't have enough data on past performance, past impact, so to speak. And even in these data, we don't exactly know whether we don't observe big impacts, for example, because everything was insured. And we don't necessarily know whether the insurance will be still there in the future. We don't know also much about the value of adaptation. So I can be in the same place, exposed to the same risk, just being a bit smarter than I putting my stock 1 meter up, for example, that kind of things. So there is a lot of things that you can do to limit the impact in the end. And I think collectively, insurance companies, to the extent I know, are struggling to assess that value. Just imagine what it means for banks to have an idea about that. So when they ask firms, do you have an adaptation strategy? Maybe the answer is yes, and then you know that something has been done, but you don't know exactly what's the value of what has been the value with regard to reducing the impact of what has been done. Which brings me to answering your second question, Peter, if I may. There are things we know. There are things we know we don't know, and for these things, instead of contemplating the huge number of things we should be doing, let's focus very pragmatically on a number of things. Do it well at a smaller scale, and then scale up that to the bigger problem. Because I mean, the task is huge, and basically, if we have a top-down approach saying a good enough question will be good enough, from a top-down perspective, I think we'll be missing a lot of the big issues. So maybe there's a case for starting more at the asset or the portfolio level, doing the analysis right, and then looking at how to expand that to the broader portfolio and balance sheet, rather than trying to provide an approximate answer to the question that is good enough, with having in mind that maybe in 2 years' time I will do something that is a bit more precise for the whole stuff and so on and so forth, because I'm not completely sure that this will converge in the end, this approach.
If I can rebound, today we have the tools, well, at least at Climera, we have the tools to really understand how adaptation strategies can really impact the financial risks that a company makes. And we can really transfer how much it costs to deploy those strategies and how much we will gain at the asset lifespan by doing that strategy. And those financial information must be transferred to insurance company and banks company, because I really think the future of insurance in a risk world where risk is completely exploding is really linked to the capacity we will have to find those companies and those homes that have been adapted, and not just the ones that don't have any risks, because basically in 50 years, nobody will be not touched by a risk. So we need to find solutions to create resilience at the asset level, at the portfolio level, really physical resilience, to be able to find ways to have a livable future, and so an insurable future. Because places that are not insurable are places where living will be very hard in the future, in fact. So we need to have a step more and be able to help companies and portfolio managers to find those solutions to really adapt their buildings, their structures, to be able to resist more to those events, even if they are exposed to. And once they can resist, we can easily insure them.
Yeah, but and we also, to come back also to Jean's point, we also need to make sure that we influence rightly the decision, and we have the responsibilities that are correctly allocated. I mean, if you think about how we build things in France, you know, there was a law like 10 years ago to say that before building a house, you need to check the soil and to have a full study, and potentially to build it differently if you want to adapt to drought. And the studies are now being done, but sometimes people just ignore the recommendation of the study and still build without having taken into account the impact. And why? Because, I mean, from the bank side, as you said, it's funded based on the income, not based on the value of the house. So somehow it's not so bad if even if the house disappears. I mean, the banks might still get paid up to a certain point. From the insurance perspective, you cover over the next year. You have the cat nat regime, so you can always say, okay, worst case, I will ask the cat nat regime to pay more, or just stop insuring this house. And the person that decided to buy probably isn't really aware of this risk, or does not know it really well, and still goes ahead. And we build a house that in 5 years will be destroyed because of drought. So we need to find also a way to convey the right incentives to the right parts of the financial sector or to the individuals, but just making sure that in the end we take appropriate decision, taking into account the evolution of the risk through time. And we are not fully there yet, and prevention has a role to play, but so if we want people to invest in prevention, they need also to have skin in the game, and that is true for the insurers and for the banks, I would say.
Thank you. So we are running out of time, but maybe we can still take one question from the audience. Yeah.
I have one which is maybe a call for more data, because I can take the investor hat here and really say that we need the two measures you mentioned, insurance coverage at the company level and adaptation measures. One issue is that for adaptation, we only rely on voluntary disclosure. And it's completely imperfect, and we know that, but that's all we have. And for insurance, and then I'm turning to you, Peter, I think maybe there is scope to gather insurance data, anonymized, because we don't need to know that Allianz has this kind of exposure. We just need to know the broad coverage of a particular company by the full insurance sector. So if you could, maybe with Spark and Planifest, gather information from insurers in an anonymous way, and then aggregate that, just get the full insurance coverage of a company would be super useful. And we crucially lack this kind of data. So this is a call for...
Thank you very much, because this is exactly what I wanted. This is what, one word. This is what I wanted to say. From an academic perspective, we have a lot of data on climate. I mean, climate data is free, it's readily available, very easy to get. Then I understand that data on individual exposures of an insurance company is confidential. But there is a brick that is missing, and that is some aggregate exposure to calculate, for example, damage functions, because it's very difficult to find the damage functions, how a specific building, for example, will be damaged by a cyclone of a specific intensity. And one should be able to construct very detailed databases working together that everybody would be able to use.
I fully agree, and I think this is improving, but it's improving very slowly. I think CCR, in France, we have the luck of having CCR, and they have a lot of data, and we are more and more okay for this data to be used more extensively. Now we also need to keep in mind that it's not that easy to model it correctly, because of course you have the damage, but then you have the BI. You need to understand how it will be repaired, what are the conditions of the contract. So it's possible, but it will take time. I think with CCR we are slowly getting there.
One just as last comment. So banks, they have. Banks, they rely on the expectation, which is an illusion, that insurance will absorb all the shocks further on as they do it now. And this, so basically what Laurent, you were saying in the introduction, that, oh, whatever happens, there is insurance always, right? So it is an illusion thinking that insurers will continue as they do it now. And we see country by country, in the UK, in the US, state by state, so it's starting. So indeed, France will be maybe one of the last ones to affected by this, because of mutualization. But again, because of mutualization, so it is mutualization that blocks us from taking action, because it's like everybody's taking morphine, and there is a cancer, but we all take morphine. Okay, let's go. We don't feel the pain, right? So yes, banks, they have the false illusion that insurers will continue as they do now during the next 5, 10, 20 years. And the shock, the real shock, the hidden shock will happen the day when insurers say, stop, no more. And they will withdraw one department by another department. Just a quick number, in France, statistics say that on average, every year, 45% of claims for flooding happen in safe areas. According to PPRI, so Plan de Prévention Risque Inondation, these are safe areas. These are not flood-prone areas. In the UK, in the US, it's 20-25%, depending on the year. So order of magnitude. So at one moment, insurance company, they say stop. And the question is when?
Last comment, anyone? Jean, Priscille?
Maybe looking to the future, definitely there is questions to all. I mean, the insurance sector and the banking sector will be challenged by these developments. But I think that we still have time and resource, basically, to take the right decisions. And to be able to shift, adjust, and adapt the system in a way that makes it sustainable. That being said, if we don't do anything, I would agree with Elena. Not much hope to see the system continuing as it does, and actually we already see some banks saying that asset in that place I won't finance because I know that in 20 years' time it's not a risk because it's flooded every day, or you know.
Thank you, Jean. So we close here, and let us thank all the panelists of this session and also the keynote.